The global physical gold market operates through an intricate web of refining centers, trading hubs and distribution networks that have evolved over decades to facilitate the movement of approximately 500 tons annually. However, recent disruptions in this finely tuned ecosystem are creating unprecedented stress points that may fundamentally alter how gold prices are discovered and transmitted across different geographic markets. The London-Zurich-Shanghai triangle represents the backbone of international gold flows, handling roughly 75% of global wholesale transactions within this system. Even minor disruptions can cascade into significant market dislocations, creating arbitrage opportunities, while simultaneously fragmenting global liquidity pools in ways that challenge traditional price formation mechanisms. The contemporary gold supply chain relies heavily on a hub-and-spoke model centered around London's LBMA system, which serves as the primary clearing mechanism for international transactions. And, from London, refined gold typically flows through Zurich's storage facilities before reaching Asian consumption centers, primarily Shanghai, where the world's largest physical gold exchange operates. This architecture has historically enabled relatively seamless arbitrage between regional markets, keeping geographic price differentials within narrow bands of 2 to 105 per ounce under normal conditions. However, the increasing financialization of gold markets through ETFs and derivatives has created a parallel paper trading ecosystem that sometimes decouples from underlying physical realities. Swiss refineries processing approximately 70% of global newly mined gold represent a critical bottleneck in this system, and with limited refining capacity expansion over the past decade, these facilities operate near maximum throughput, leaving little buffer for demand spikes or supply disruptions. Several structural factors are converging to strain the traditional supply chain. First, environmental regulations in Switzerland have effectively capped refinery expansion, while Chinese domestic refining capacity remains largely dedicated to serving local demand, rather than international markets. Transportation and logistics have become increasingly complex following enhanced security requirements and insurance costs, as the physical movement of gold bullion now requires specialized logistics providers with limited capacity, creating scheduling bottlenecks, particularly during periods of heightened demand. Storage infrastructure presents another constraint, since secure vaulting capacity in key financial centers has not kept pace with growing institutional demand, leading to queuing effects that delay settlement and create temporary supply tightness in specific locations. Perhaps most significantly, the rise of central bank purchases has altered traditional flow patterns, and when institutions like the People, as Bank of China, or the Central Bank of Turkey execute large acquisitions, they often prefer domestic delivery, bypassing traditional European transit routes and creating unusual demand pressure in regional markets. These supply chain stresses manifest most visibly in the emergence of persistent regional premium differentials that exceed historical norms as Shanghai Gold Exchange premiums over London. Spot prices, traditionally ranging from 2 to 8 per ounce, have periodically spiked to 25-30 during periods of physical tightness. Similar divergences have emerged between Istanbul gold markets and European benchmarks, particularly when Turkish central bank purchases coincide with retail demand surges during periods of lira weakness. And these premiums reflect not just transportation costs, but genuine scarcity of immediately available physical metal in specific geographic markets. The most striking development has been the persistence of these premiums, even when paper gold prices suggest abundant supply, which suggests that traditional arbitrage mechanisms are becoming less effective at equalizing prices across regions, potentially indicating a structural shift in how global gold markets function. The underlying economic forces driving these phenomena reflect a complex interaction between physical constraints and financial market dynamics, and when paper gold markets dominated by futures and OTC derivatives signal abundant supply through low volatility and tight bid-ask spreads, but physical markets simultaneously exhibit scarcity premiums. It suggests a breakdown in the traditional transmission mechanisms between financial and physical gold. This disconnect creates opportunities for sophisticated market participants, while potentially distorting price signals for broader market participants, as arbitrage traders must now factor in not just transportation costs and financing rates, but also the probability of physical delivery delays and the opportunity cost of capital tied up in transit. Central bank purchasing patterns exacerbate these dynamics by removing substantial quantities of gold from the traditional dealer network permanently. And unlike commercial transactions that often involve leasing or rehypothecation, central bank acquisitions represent definitive withdrawals from circulating supply. The increased preference for domestic storage by many central banks further constrains the recycling of gold through traditional trading channels, and this one-way flow characteristic of recent central bank purchases reduces the velocity of gold circulation and can create semi-permanent regional supply imbalances. These developments suggest a potential evolution toward a more fragmented global gold market structure. And rather than a single globally integrated market with minimal geographic price differences, we may be witnessing the emergence of distinct regional markets with persistent price differentials reflecting local supply-demand conditions. Such fragmentation could have profound implications for price discovery, and if London remains the primary financial trading venue while Shanghai becomes the dominant physical consumption center, the relationship between financial gold prices and physical market conditions could become increasingly tenuous. This structural shift may also affect the traditional role of gold as a portfolio diversifier, and if physical and paper gold prices diverge significantly during stress periods, investors may need to reassess their exposure strategies and consider whether their gold investments provide the intended hedging characteristics. The implications for monetary policy transmission are equally significant, as central banks using gold purchases as a tool for currency diversification may find that their actions have outsized impacts on regional physical markets, potentially creating feedback effects into broader commodity and currency markets that were not previously observed when gold markets were more integrated and liquid. The global gold market appears to be undergoing a structural transformation driven by supply chain constraints, changing demand patterns, and the increasing importance of central bank activity. And while these changes create new trading opportunities, they also introduce complexities that may challenge traditional understanding of gold market dynamics. Market participants, from institutional investors to monetary policymakers, will need to develop new frameworks for understanding these evolving dynamics, as the assumption that gold represents a uniform, globally integrated market may no longer hold, requiring more nuanced approaches to valuation, risk management, and strategic allocation decisions in precious metals portfolios. The emergence of blockchain-based settlement systems and digital gold tokenization represents another layer of complexity that may either alleviate or exacerbate existing supply chain tensions, as these technological innovations could potentially bypass traditional physical delivery mechanisms while creating new forms of counterparty risk that market participants have yet to fully understand or price appropriately. Several major bullion dealers have begun experimenting with distributed ledger technologies to track physical gold movements from mine to vault, potentially reducing settlement times and verification costs. However, these systems remain fragmented and lack the standardization necessary for widespread adoption across the international trading community. The increasing role of sovereign wealth funds and pension systems as long-term gold holders introduces additional structural shifts that may permanently alter market dynamics, as these institutions typically employ buy and hold strategies that remove substantial volumes from active circulation for extended periods, effectively reducing the float available for daily trading operations. This phenomenon becomes particularly pronounced when combined with the growing trend toward ESG-compliant gold sourcing, which requires additional verification procedures and often limits the pool of acceptable suppliers, creating potential bottlenecks even when overall global supply remains adequate. Regulatory developments across multiple jurisdictions are simultaneously creating new compliance requirements that add both time and cost to international gold transactions, as financial authorities seek greater transparency in precious metals trading while combating money laundering and terrorist financing through enhanced due diligence procedures. The implementation of various beneficial ownership disclosure requirements and enhanced customer identification protocols has resulted in longer settlement periods and increased operational costs for many market participants, particularly smaller dealers who lack the technological infrastructure to efficiently manage these expanded compliance obligations. Climate change considerations are beginning to influence gold supply patterns as mining operations face increasing scrutiny over their environmental impact, potentially affecting future production capacity from certain regions, while simultaneously driving demand for recycled gold that must flow through the same constrained refining infrastructure. The transition toward renewable energy sources in mining operations, while environmentally beneficial, often requires significant capital investments that may temporarily reduce output from affected facilities during upgrade periods, adding another variable to already complex supply forecasting models. Geopolitical tensions have introduced additional unpredictability into traditional trade routes, as sanctions regimes and export restrictions can rapidly reshape global flows, forcing market participants to develop contingency plans for scenarios where primary trading relationships become unavailable due to political considerations rather than economic factors. The increasing frequency of financial sanctions as a diplomatic tool means that gold trading firms must now maintain more diverse supplier and customer bases to ensure operational continuity, which often requires accepting higher transaction costs and longer settlement times as the price of reduced concentration risk. Insurance and security requirements for physical gold transport have evolved significantly in response to both heightened threat environments and increased cargo values, resulting in higher premium costs and more limited capacity among specialized logistics providers who must meet ever more stringent security standards. The consolidation within the specialized gold transportation industry has created oligopolistic conditions where a small number of firms control most international shipment capacity, potentially creating systemic risks during periods of peak demand or operational disruptions. Digital infrastructure dependencies have become increasingly critical as market participants rely more heavily on electronic trading platforms and automated settlement systems. Yet these systems often lack the redundancy and fail-safe mechanisms that might be expected given the value of transactions they process, creating potential points of failure that could cascade across interconnected markets. The growing sophistication of cyber threats targeting financial infrastructure raises questions about the resilience of digital gold trading systems, and whether market participants have adequately invested in cybersecurity measures proportionate to the risks they face from both state and non-state actors seeking to disrupt global financial flows.